Welcome back to the Big Money Big Daddy Show. It is Saturday afternoon. Hopefully everybody in Houston is drying out from the monsoon that was dumped upon us this past week. But we are here talking about investments, and we're going to talk about some science and math, but mostly science of how we design portfolios. So
She blinded me with science, science. She blinded me with science.
We couldn't. Apparently, we couldn't get the audio clip to play for that, so Mark decided to take that upon himself. And
How do you like that singing?
wow! All right. Yeah, so we're going to get into a little hypothesis and laws of nature and all kinds of good stuff here, and relate it back to how do you invest in a good portfolio.
I think we can do that because the first segment was about hype and people trying to sell something to get you emotionally to move on hype. Well, we don't go for that because we haven't found anybody that can hype something and then continually and consistently make predictions and then come out and it be profitable for investors. It's very profitable for the people creating the hype, not so much for you, the listeners, and our clients. We take a different approach. Instead of hype, we do good old, boring, old-fashioned math and science. And so we like to compare things. I mean, what's a law of nature? Okay, as we were looking at Wikipedia here, and it's a law whose content is set by nature, and that therefore has validity everywhere. And I think that is kind of, if you think about Newton's, he's got the 3 laws of motion. Is that what it is? Yes. You can Wikipedia that. Make sure. When I get to the actual physics, I'm not as good as on the portfolio design, mind you. But I do know that, when we look at science and what Dale said, a hypothesis, it's testable. Okay. Science is testable, and that gives us an opportunity to look into things. Like, for instance, when you look at scientific theories, they would tell you that if I dropped a feather and a bowling ball, and it was in a vacuum where you didn't have any air friction, you drop them, that they would actually hit the ground at the exact same time. And so the question is that true? And cool enough, when I'm sitting there flipping through the channels, Mythbusters had a deal on that, and they had a vacuum, and they actually did it. And sure enough, the feather and the bowling ball hit the ground at the exact same time. So science has theories, hypothesis, and is that hypotheses?
If there's more than one.
Okay. All right. So you come up with that and then you test it. Well, you can apply those same things when it comes to an investment portfolio. And that's what we wanted to cover in the second segment, instead to get you away from the hype and look at something that you can test and that you can look at, or what we call the science of investing, just as the feather and the bowling ball. And it's interesting to think of what the friction is when it comes to a portfolio. Because if I drop a feather and a bowling ball and I'm not in a vacuum, the bowling ball hits the ground first because the feather's getting friction. So I'm always thinking of what things are considered friction when it comes to your investment portfolio. Well, I think probably the biggest one that gets ignored all too often is human behavior. Human behavior is the biggest problem with an investment portfolio, and everybody else, when you're listening to it, you're probably shaking your head. Oh yeah, I know about, my spouse. Oh yeah, I know about my buddy. He lost all his money due to that human behavior. We never think it's us. We do it by the book. I mean, we know how to build the portfolio. We don't listen to the hype. We don't have the human behavior problems. Well, you sure? Do you stress about your portfolio? Do you have anxiety, frustration? Have you ever made a move based upon emotions instead of there being a fact? Well, if you're being honest, most people have. And that will cost you dearly. That's part of the Dow Bar study that comes out every year, shows what the actual stock market returns are, which, depending on the time frame you look at, generally it's all long term, so 9-10% rate of return. and it shows the actual investors normally getting somewhere around 3.7%. And that's just, as I said earlier, is pathetic. It's, people come in my office, they would like to get stock market returns with T-bill type risk. And the reality is they're taking stock market like risk and they're getting T-bill type returns. And that is not what you should be doing. But I think that that's a friction. I think people are unaware of the friction of cost in their portfolios. As you buy and sell, there's a difference between the bid and the ask price. And the more that you do that or hire someone to do that or a mutual fund that does that, it's going to be reflected in lower returns. And a lot of people don't even know that that cost is there. There's expense ratios. There's advisor fees. There's commissions. All these frictions come into play. And if you haven't done an analysis of what's actually going on in your portfolio, you have no idea. I mean, you're trying to get that feather to hit before the bowling ball and you're in a wind tunnel. It ain't going to happen. Okay. So what we want you to do is start to know these things. So let's look at what the science is when it comes to an investment portfolio. First, it is that the return on capital is the cost of capital. Okay. This is the CAPM model. This is what we call the three-factor model. I'm not going to go through, a bunch of formulas, but I do know that if I look at, average expected returns is going to be equal to the excess returns plus the sensitivity of the market. That's some of the math. We let brilliant minds, Nobel Prize winners come up with this stuff. I want to convey it, though, in a way that helps you understand. The bottom line of all these formulas and what they figured out is that 95% of the return that you get in a portfolio is explained by the asset allocation of the portfolio. Let me restate that. 95% of the return of the portfolio is asset allocation. Everybody thinks it's the stocks you pick or whether you were in or out of the market with the right timing, and that is not. If you want to get the best return possible, you need to focus on what percentage should go into all the different asset classes. And so when I look at what we call the dimensions of stock returns, what goes into how can we, I guess, let me try to rephrase this. If you just went out and you bought every stock on the stock market, okay, according to S&P, they come out with a report every year, but if you just did that, you would outperform, generally speaking, about 70 to 80% of the top money managers in the business. That is the smartest, the wisest, and the brightest of all money managers. Let that sink in. If you bought every stock. Now, when people come to Wealth Design Group, they're looking to do better than just that. But I will tell you, if you just went out and did that and never did anything else, you're going to be better off. So what are the dimensions that we look at when we look into stock return? Number one, does the equity market actually give a return for the expected risk that you're taking over that of if you just put your money into something that's more fixed? Question number one. Company size is the next issue. If I buy smaller companies, do I in fact get better return over time than that of buying large companies? And number three, how does the current pricing of a company as measured by the ratio of company book value to market equity, how does that compare? If I'm buying something that's distressed or by academic definition, if it's a value stock, and don't get confused with that term because I know a lot of mutual funds out there call themselves value, but they're not using the academic definition. So you know what? I'll just call it a distressed company due to the pricing of where it's currently at. Do those areas actually give us more return over time? Well, let's answer the question. I mean, if I look from 1927, this is all the way through 2014. If I look at all stock investments minus T-bills, which is considered the safest investment, does the stock market give what we call as a premium or better return? And the answer is over that period of time, more than 8% extra return. That's substantial. What about if I buy small companies? Over that time, it's almost 3% extra return over that of large companies per year, mind you. What about distressed? Okay, high book to market minus the low book to market. It's 4.76% extra return for purchasing those areas. You see, there are ways to get extra return, and they have nothing to do with picking the right stocks, the right mutual funds, or timing the market right. That's the reality of the situation. That's what goes into the modeling. So let me kind of give a brief explanation of a way to think about it, because it actually makes sense, all right? Number one, I think most people out there listening agree. Okay, yeah, stocks over time perform better than fixed income instruments. All right, we're cool on that. Let's just move from there. What is this deal about small companies? Well, wouldn't you agree that if I buy a small company, that it's more likely to have more room for growth than if I went out and bought a big company like a Exxon, or Apple Computer, whatever it is? Well, sure. But what will come with that? You guessed it. There's going to be a little more risk with the small company. No doubt about it. But you are able to achieve better returns historically. Nobody knows what's going to happen in the future. All I can do is give you some data to work on. What about value companies? Well, what does that really mean? Okay, so think about it. If I've got a value of a company and I was just to come in and do a fire sale and just, the going out of business that every furniture store has, okay? There's the fire sale, right, of the value of just the furniture. But the actual business, if it wasn't a fire sale, they would sell it for more than that because there's goodwill that goes into a business. Okay, they've made a name for themselves. They have great customer service. Okay, that's not a value that you can liquidate, but that goes into what the value of a business is. That's why businesses trade at multiples of their book value. So their actual stock price is way higher than that. Well, what happens if that stock price starts falling and coming down and down closer and closer to book value? It's distressed. Something's wrong. It's riskier. So do you get return for that risk? And the answer is you do. Okay. From what the numbers I just gave from 1927 through 2014. So you're compensated for that. So I get it. A lot of people are listening to that and they say, all right, well, fine. So yeah, if we take a bunch more risk, we can get some more return. But here's the cool part about it. This is the way we put some science together. Well, Dr. Markowitz, who also won the Nobel Prize in 1990, what he figured out is that, yes, 95% of the overall returns is based on asset allocation. So why don't we, if we know the returns of each of the major asset classes, such as small companies and large companies and value companies and growth companies in both the U.S. and then repeat all that in international, if we know the returns, and we know the standard deviation or the risk or how much something deviates from its standard return, okay? And we measure what's called correlation, and we measure it mathematically. That means when small companies move upward, how often do large companies also move upward, and to what degree? That gives us what's called a correlation, a mathematical way. The way most people diversify is they just go out and buy a bunch of stuff and think they're diversified, having no idea that the stuff they're buying is normally all buying the same things, or they think diversification just means that they're unrelated. In other words, if I go and play roulette, that's totally and completely unrelated to the returns of the stock market. So they're unrelated, so it is diversified from that, but there's not a increase in the chance that you're going to do well, so I wouldn't advise that as well. But if you put all that in there, you can calculate the exact percentage that should go into each of those asset classes to give the maximum return. So, you know what we've just accomplished? Giving you these extra returns in these categories, but we've reduced your risk. In other words, think about this. Mrs. Retiree out there that thinks by just owning all large companies because you've heard of the names and they're paying dividends that you have lower risk. The reality is if you added some small companies to that portfolio, not only would you get better return, you actually would have less risk. Well, we're going to put that to test in the last segment, but we definitely want you to know about our coaching sessions that are coming up.
Yeah, so we've got our next session coming up in June. So please text the word daddy to 72727. That's text the word daddy, DADDY, to 72727. When you do that, that's going to send you a link You'll just type in your name and your email address, and then that will put you into the system, and we will send you the dates, not only to the upcoming event in June, but you will also get notifications on all the rest of the events that we've got coming up for the rest of the year. We're going to take a break, and we're going to come back and finish the show strong.
Big money, Big Daddy. The S&P 500 index is a market index generally considered representative of the stock market as a whole. The index focuses on large cap segment of the U.S. equities market. Barclays U.S. Aggregate Bond Index represents the U.S. investment grade fixed rate market. NASDAQ Composite Index is a market value weighted index that measures NASDAQ domestic and non-U.S. based common stocks listed on the NASDAQ stock market. Each company's security affects the index in proportion to its market value. The small company, distressed, large value, and small value indexes were the crisp market indexes. Indexes are used and are unmanaged, and one cannot invest directly in an index. Investing in securities of smaller companies tends to add and be more volatile and less liquid than securities of larger companies.